A $2,000 rent and a mortgage calculator that says $2,000 are not the same price. One of them costs you $2,000 a month. The other one costs something quite different, and the gap is bigger than most people expect. There is one number inside that first mortgage payment that changes the entire comparison, and most people barely think about it. I will show you exactly which number. But first, the sentence that gets said at every family dinner: renting is throwing money away. You have heard it. Somebody has said it to you, probably while implying that you are behind. And it is hard to argue with because rent really does leave and never come back. The problem is what people assume about the other side, because a large part of a mortgage payment also leaves and never comes back, and that part is much bigger than it looks. So, let's run it. Real numbers, out loud, every assumption stated so you can swap in your own. A $400,000 house, 20% down, which is $80,000, leaving a $320,000 loan. 30 years, 6%. The principal and interest payment on that comes to about $1,900 a month. And there it sits, next to a $2,000 rent, looking almost identical. This is usually where the argument ends. Same money, but one of them builds equity. Obviously, you buy. Okay, the number. In the first month of that mortgage, about $1,600 of your $1,900 payment is interest, not principal. Interest. Money that goes to the bank and does not come back. In the same way rent goes to a landlord and does not come back. About $319 actually reduced the loan. The rest bought you the use of somebody else's money for a month. And to be clear, this is not hidden from you. The split is right there in your amortization schedule, and any mortgage calculator online will show it to you in about 90 seconds. The problem is that rent versus buy conversations compare the headline payment and stop there instead of asking what each part of that payment actually does. Now let's finish the bill, because interest is only the first item. Property tax depends entirely on where you live, and the range is enormous, so go look yours up. For this example, 1% of the value a year, $4,000 or about $330 a month. Insurance, call it $150 a month. Again, your number, not mine. Maintenance. For this example, let's budget 1% of the home's value a year, which is another $330 a month. Some years it is zero. Then one year, the roof happens. Add up everything that leaves and does not come back. $1,600 of interest, $330 of tax, $150 of insurance, $330 of maintenance. About $2,400 a month. Now, two numbers here, and it matters that you keep them apart. The money actually leaving your account is higher, around $2,700, because you still have to pay the principal too. But that $319 is different from the rest. It leaves your account and does not disappear. It reduces your debt. So, $2,700 out the door, of which about $2,400 is gone for good. That $2,400 is the number to hold next to rent. Renting the same place costs $2,000. The payments looked identical. The burn is about $400 a month higher on the buying side, and we still have not talked about the $80,000 in the down payment. That money is now equity, so it has not vanished, but it also cannot be doing anything else for you at the same time. What that costs depends entirely on what your realistic alternative was. Quick and important thing, this is general education, not personalized advice, and rent versus buy is the most personal financial question there is. Mortgage structures, tax treatment, tenant protections, and closing costs vary enormously between countries and even between cities. Everything here is a method, not a verdict. Take the method, put your own numbers in it, and the answer may well come out the other way. Which is fine, because that is the point. Now, the move. Here it is in one sentence. Stop comparing rent to the mortgage payment and start comparing rent to the money you burn. Add up the interest, the property tax, the insurance, and an honest maintenance allowance. That gives you a much better estimate of your monthly burn than the number the calculator showed you. Principal is the one part that behaves differently. It is mostly you moving money from one pocket into another. It reduces your debt instead of leaving your life. Everything else is the cost of having a roof, and renters pay their version of exactly the same thing. There is one more item in the bill, and in most cases, it is the one that decides the argument. It costs money to buy a house, and it costs money to sell one. Closing costs, fees, commission, transfer taxes, the move itself. Let's assume 8% across both ends for this example. That is $32,000 on a $400,000 house, and it does not care how long you stay. So spread it across how long you stay. 3 years is 36 months, and $32,000 divided by 36 is about $890 a month on top of everything else. 10 years, the same cost becomes about $270 a month. 20 years, $130. That single division is why the same house can be an obvious mistake and an obvious win. Now watch what time does to the math. At 3 years, buying in our example burns about $2,400 a month plus $890 of spread out transaction cost. Call it $3,300 against $2,000 in rent. In this example, buying and selling again after 3 years is an extremely expensive way to move house. At 10 years, that transaction cost thins to about $270 a month, and something else has been quietly happening the whole time. As the loan pays down, the interest portion shrinks every single month, so the burn is lower in year 10 than it was in month 1. Same payment, different composition. The gap narrows. By 20 years, our example may look completely different. Much more of the payment is going to principal. The transaction cost has been spread across 240 months, and rent has had 20 years to do whatever rent does in your city. With a fixed-rate mortgage, your principal and interest payment stays put while the interest portion falls. Taxes, insurance, and maintenance are another story. Those can climb right along with rent. Same house, same mortgage, different time horizon. Completely different answer. Now the honest part, because this arithmetic does not capture everything, buying buys security of tenure. A landlord cannot suddenly decide to sell the place out from under you, or raise the price at renewal, or take 4 months to fix the heating. If you have ever been made to move when you did not want to, you already know that is worth real money, and it is not on any spreadsheet. Renting buys flexibility, and that is the thing renters are actually paying for. If the job goes bad, if the relationship ends, if the better opportunity is in another city, a renter gives notice, and an owner starts an 8% transaction. And none of this captures what house prices will do. I have assumed zero appreciation throughout, not because prices never rise, but because nobody knows. If buying only works because you are counting on the price to bail out the math later, you are not comparing housing costs anymore. You are making a bet on the asset, and you should at least know that is what you are doing. Now the objection. But renting is throwing money away. Here is the thing. Rent is not throwing money away. It buys you somewhere to live. And interest is not throwing money away either. It buys you the use of $320,000 you did not have. Insurance buys protection. Taxes buy roads and schools. Maintenance keeps the building standing up. Both renters and owners spend money every month that they will never see again. That is what a roof costs. The only real difference is that one of those payment stacks contains a slice that builds equity, and in the early years that slice is small. So the useful question was never which one wastes money. It is how much each one costs for the life you actually want. The second objection is quieter, but at least with a mortgage, I am forced to save. That one I will actually grant you. The principal portion of a mortgage is a kind of forced saving, and for a lot of people that behavioral advantage is worth more than a slightly better spreadsheet. Just be honest that this is what you are buying, rather than believing you found the cheaper option when you did not. So, this week, 3 things. First, find the real rent. Not a feeling, not what you paid 4 years ago. Look up a few genuinely comparable rentals, similar size, similar condition, same area, and take the middle. That number is half the comparison, and most people never look it up. Second, work out your burn. Pull up an amortization calculator, enter the loan, and look at how much of the first payment is interest. Then add property tax, insurance, and something honest for maintenance. Put that total next to the rent. Third, answer the uncomfortable question. How long are you actually going to stay? Not how long you hope Then take the buying and selling costs, divide by that many months, and add it to the pile. If the answer still comes out in favor of buying, buy it, enjoy it, and stop reading spreadsheets. But now you will know why. Because a $2,000 rent and a mortgage calculator that says $2,000 are still not the same price. Same monthly number, completely different math.